Welcome back to another video. In this video, I'm going to cover why I think the stock market has been so volatile lately and what you should do about it. As always, I'm not a financial advisor, I'm not a financial professional. Don't make any financial decisions based on what I say. These are a conglomeration of my own opinions based on what I've observed over the past year in the market. Firstly, how do we measure volatility? So there's something called VIX, which is the volatility index, and it measures the expected volatility of the stock market. I won't cover how this really works because it's definitely more complicated and warrants a video on its own. But if we take a look at the past 5 years, notably in March of 2020, VIX had a huge spike as everything hit in March, as there was a lot of uncertainty, a lot of fear in the markets. And even within the past 6 months, there have been periods of large spikes. And even though volatility sometimes cools down, I feel like every day there's something in the markets moving up 50%, something moving down 20%. It's crazy. So in an ideal market, I think something called the efficient market hypothesis would hold true. This in economics is essentially saying that all share prices reflect all information. And all information here I would assume to be news about the company, whether good or bad, earnings, acquisitions. So according to this theory, stocks would always trade at their fair value, which means that it would be impossible for investors to purchase undervalued stocks because, again, they would always be perfectly valued, so you can't buy something that's undervalued. And similarly, you would not be able to sell stocks at inflated prices because it would be the fair value of a company. I think it has become more and more evident over the past year that this hypothesis is simply not true. For example, if GameStop goes up 100% in one day, I don't think the value of the company has increased 100% by a day. For the most part, humans are in the markets. Humans are the ones trading and investing and making the algorithms that trade in the markets. What makes us humans are that we have emotions. These emotions are what lead us to sometimes make irrational decisions in the market. For example, a lot of people, contrary to the simple mantra of just buy low, sell high, right? It sounds so easy. They instead buy high and sell low because they see a stock going up. They're like, oh my God, I want to get in on the action before it goes up even more. And of course, at the point you buy it, the second you buy it, it decides to turn around. And similarly, if you've ever been in a position where you're holding a stock and it starts to go down, you're like, oh my God, I need to sell before it goes down even more. So you end up selling here. And the second you sell, what does it do? It turns around and goes back up again. And you're just frustrated. The market's playing with your emotions. A large catalyst, I believe, in the volatility in the markets is the influx of new traders and investors in the markets. And obviously this is because of everything that took place at the beginning of last year. Here's a short timeline of what happened. Essentially, in March, everything closed down. A lot of people are stuck at home. The unemployment rate went up. For example, in April, it was as high as almost 15%. So more than 1 in 10 people was unemployed in the United States at least. And I think due to this, and due to all the stimulus that was passed, a lot of people are in the markets out of desperation. If they got a stimulus check, sure, it might cover a couple months of rent, but some people took their stimulus checks into the market and YOLO'd it on very high risk, very low probability of profit outcomes in the hopes that they could 10 times, 100 times their money, which I believe added to the volatility in specific stocks. And similarly, I think a lot of people join the market for fun. They may have been bored, they may have been unemployed and sort of at home with nothing to do. Some people treat the stock market as a casino. You can bet on a specific stock, put in a lot of money, and if it goes up, you win big. So some may see it as a replacement for gambling, which can become very, very dangerous. Another reason I think there has been an influx into the market is because yields are so low. So interest rates are really low, which means that high yield interest savings account or general savings accounts have really low rates. So this screenshot is from Marcus by Goldman Sachs, and I actually do have a savings account with them, but I currently don't keep any money in there because the APY or annual percentage yield is 0.5%. So this means if I put in $100 at the beginning of the year, after 1 year, it's going to be $100.5. You'll earn an amazing 50 cents after 1 year of keeping your money in there. Now, obviously, this return doesn't seem great, and this is compounded by the fact that you see people left and right making hundreds of percents, thousands of percents in a single day in the stock market. So a lot of people don't put money in a savings account, and instead they try and chase higher returns in the stock market. Despite all of the sort of drama that Robinhood has come under lately, I really do think Robinhood has opened the door for a lot of newer investors and newer traders to get into the game. For example, if we take a look at their total transactions, it's been increasing a lot essentially over the past couple years, and it more than doubled in 2020 to $350 billion. And similarly, the number of Robinhood users has really ballooned over the past couple years. In 2020, they surpassed 13 million people, and in 2015, they only had 0.5 million people. And a couple other small facts, The average age of the Robinhood customer is 31, and half of its customers had never invested before. And this is an interesting statistic because it means that Robinhood allowed people to get into the game. And according to JMP Securities, the average account size ranges from $1,000 to $5,000. Relatively speaking, this is small compared to brokerages like Charles Schwab, where I believe the average account size is over $200,000, but they did surpass 13 million users in 2020. And this little blurb at the bottom will become important in a little bit. But Robinhood introduced no commission trading, so you didn't have to pay a commission to buy and sell stocks. In order to stay competitive, a lot of other large brokerages like Charles Schwab, like TD Ameritrade, they also lowered their commissions, where stock trading now has no commissions and options contracts still have a smaller commission. Industry-wide, commissions have decreased, which allows more investors to invest and trade, which is really great. It opens the door to a lot of people who maybe have never thought about this before. Another thing that I think has been playing into the massive rise and massive falls of a lot of stock is the news. Again, as I briefly mentioned, people are bored, they're at home, they're on Twitter, they're on Facebook, they're on Reddit, and there's a lot of information, a lot of news, and the news that really sticks, a lot of people see it, and it can lead to things like the GameStop short squeeze, which I'll use it as an example a lot, but it's just a perfect example of everything that's been happening, where the beginning of January, this was a sub $50 stock. During the short squeeze, it reached levels of $350, I think almost $400 intraday, and coming back down to $50, all within the course of a month. So news is playing a huge deal in how some stocks are moving. And as a lot of you may know, a lot of this news and sort of speculation is circulating on a Reddit forum called Wall Street Bets, where there are currently 9.4 million people. If something gets said in this forum and a lot of people see it, 9.4 million people in the stock market can move a stock, especially a small cap stock. Additionally, I think finance has been getting more in the public eye over the past year. So for example, big YouTube channels like Meet Kevin, Andre Jick, and Graham Stephan, who I'm subscribed to. I love their videos, they're very inspiring, and you definitely get to learn a lot from them. They have millions of subscribers, so people are evidently interested and they're learning and they want to get into the markets and they want to learn about finance, they want to learn about investing. Also, side note, can we see some more female finance YouTubers? I think there's been sort of a shift in views on the markets for some people, wherein the company value is measured by its stock price. But I think more people are treating the market as a place to make money instead of a place of storing value for specific companies. For example, there are a lot of people chasing a lot of smaller names that have gotten a lot of media attention. This concentration in these smaller stocks can really balloon a stock. So for example, earlier I briefly mentioned that the average Robinhood account size ranges between $1,000 to $5,000. This may not seem like a lot, and with 13 million users, if we assume an average of $5,000, this would be a capitalization of $65 billion. $65 billion is a lot of money, but in the grand scheme of the entire market, where there are trillions and trillions of dollars, where Apple as a single company is worth more than $2 trillion, it's not a lot. However, if this $65 billion becomes very concentrated in a few small names, it can move stocks a significant amount. I've already mentioned this stock so many times, but GameStop, their free float market cap, which is essentially the size of GameShare, so the price of one share times the number of shares, is currently around $6.4 billion. So if a lot of Robinhood users, or a lot of users in general, pile into this one stock, you can move it a lot. Another stock where you see this holding true is in AMC. Their market cap is $2.54 billion, so it takes even less to move something like AMC. And the newest stock that has been the attention of Wall Street Bets is Rocket Mortgage. Their market cap is $4.71 billion. So it doesn't take a lot to move a company like this very quickly. And you'll see that today it closed at an increase of plus 71%. So that is crazy. As people are chasing these smaller stocks or just chasing stocks in general, I think there's a snowball effect in the market, which is a manifestation of FOMO, or fear of missing out. So for example, GameStop, it kept going up, and as it kept going up, people kept buying it, and as people kept buying it, it kept going up, and then there's this cycle, and then once it starts falling, so people try and sell to get out, and as people try and sell to get out, the price goes down, then more people sell to get out, and it's this cycle of things going up very, very quickly, and then once people start to take profits, it comes down very, very quickly again. Another trend I've seen in the markets lately is that there's an overreaction to any news that comes out about a company. If the news is good, sometimes it'll go up 10%, sometimes it'll go down 20%. If there's bad news, sometimes it'll go up 20%, sometimes it'll come down 10%. It's really an overreaction in my opinion. So for example, CCIV, which is a SPAC company that is merging with Lucid Motors, which is an electric vehicle company, they announced the merger and subsequently the stock price dropped 27%. Another example of this is Workhorse Group, which is a EV company that essentially they turn gas-powered vehicles into electric vehicles. A lot of the price rise, if you'll see here, was due to a potential contract with USPS, which obviously they have a very large fleet of mail delivery vehicles. Unfortunately, they lost the contract, so in response, the stock dropped 50% overnight. It's crazy, right? So those were two examples of news-based drops. Some examples of earnings-based changes are Netflix. So I believe they announced somewhere in the middle of January. Their subscriber numbers were really strong and they had really good outlook for the future. And in response, their stock increased something like more than 15% overnight. Now this is a large company, so 15% was a lot in market capitalization. Sort of inversely, NIO had their earnings yesterday, and I believe they beat earnings per share but missed on revenue, and they said that there might be some shortage issues due to the semiconductor shortage. So in response, the stock fell 13% in one day. And one sort of conclusion I've gotten from all these examples is that the market is a self-fulfilling prophecy. As more and more people pile into a stock, this causes other people to pile into a stock, and then it becomes this snowball effect on the way up. And as people start to take profits, people start to sell. More and more people start to sell as they see other people start to sell. So it's this snowball up and down of these crazy overreactions to news, to earnings, just up and down. 10% is like nothing. It's just another Tuesday in the markets. Yet another reason I think the markets have been crazy lately is because of the stimulus that the Fed has been printing. This is a chart of the year-over-year change in percentage of the money supply. So we'll ignore the orange line, which is the M2 money supply. I might cover what money supply is in a future video. We can just think of it as the amount of US dollars that have been printed. And if we look, at least as of July of 2020, the year-over-year change in the money supply increased by almost 40%. That means that almost half of the US dollars in circulation was printed last year in 2020. And if we just look at the history, when else has the money supply increased? It increased after the dot-com bubble. It increased after the financial crisis, right? So this is in response to another crisis, a world pandemic. Basically, the Fed is printing a lot of money, and I think a lot of it is going into the stock market, which is inflating prices. Another factor I think has been playing a role is that Joe Biden is the current US president, 46th US president, and due to the office change, I've seen a rotation in and out of specific sectors. So into specific sectors, for example, the MJ sector, if we look at stocks like Tilray, which have increased greatly since the end of last year, up ridiculous amounts since like October of 2020, up 1,000% in this day range. Another stock in this sector is Afria, which similarly has seen a huge run since the end of last year. Another sort of sector I think that has benefited from the Biden administration and their sort of pushes towards renewable energy, which includes EV stocks. So for example, Plug Power, which is a hydrogen fuel cell company, has seen a huge rise since the end of 2020. QuantumScape, which is a battery company. I don't think they actually produce any batteries and they don't have any plans to until 2024, but they're valued at $20 billion. Just a comment, they have seen a meteoric rise since the end of 2020, although it has come down quite a bit as well. Similarly, in the renewable energy sector, Brookfield Renewable Partners, if we take a look at the past year, it's had a really nice run since, I guess, March, but I think this was helped by the new administration. So what should you do about all this? Again, this is not financial advice. These are just my thoughts and what I would tell myself if I didn't know anything about investing or finance at all. The market right now has an air of higher risk, higher reward. So a lot of people are taking very high risk plays like short-term options and putting in a lot of money where it can be very easy to lose 100% of your investment. I guess my sort of overarching theme is just be careful and do your own research. So for example, in trading, be very careful, especially if you're trading something that's extremely volatile. Sometimes by the time you put in an order and the time the order gets executed, the price of something will have moved so much that you might lose money instantly. Similarly, if you're trading extremely volatile stocks, be aware that sometimes they can get halted because they move so much. So for example, for GameStop, I've seen it get halted many times. I myself actually got caught up in a halt over the last week. I fortunately did come out with a nice little profit, but it was very stressful and I would not recommend doing that on the regular. In terms of long-term horizons, I myself am mostly a long-term investor. I like to trade with a little bit of my account, but my outlook is 20, 30, 40 years from now, so I don't really care what's happening on the day-to-day. It's really hard to say in the day-to-day because you see these things moving up and down. 10%, you're like, oh my god, should I buy? Should I sell? What do I do? But I always remind myself that I'm looking to invest for 20, 30 plus years from now, so I don't really care, and I shouldn't really care what happens on the day-to-day. Another important distinction is that you need to make a clear distinction between if you're investing or trading. If you're investing and a company you believe in and have done research on drops 10%, you should not panic sell. If it's a company that has not fundamentally changed, you should see it as an opportunity. It's on sale for 10% less than you bought it for. However, if you're trading, you want to maybe set stop losses for yourself, so you'll get out by the time a stock drops 5% so you don't lose anymore. Those were my musings on why the stock market has been so volatile lately. First of all, I want to thank everyone for 400 subscribers. That's amazing, and thank you all for the kind comments. I read all of them and I try to respond to as many as I can. Again, this is not financial advice, just my own thoughts and musings. Let me know what you guys think is causing the financial markets to move, and I'll see you guys next time.